Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, April 13th, 2026. The tape opened with oil risk and geopolitics in the air. But the buying pressure was louder. This turned into a clear risk-on session, led by big software and AI-adjacent names, while the usual safety trades traded like dead weight. Bottom line, yeah, the market heard the headlines, then rotated straight back into growth leadership. On the S&P 500 Heatmap, this looked like a broad rally, about two-thirds of the board in green. Technology dominated, and software was the brightest spot. Microsoft was the standout leader, and Oracle was even more extreme on the upside. The red pockets weren't random. They clustered in defensives like consumer staples and utilities, and parts of big pharma were soft, while UNH helped offset healthcare. Following that heat map, the money flow was pretty clean. Capital rotated toward growth and liquidity, mega-cap tech and software, while the classic defensive hideouts, staples, and utilities got sold. Financials and industrials leaned green too, reinforcing that pro-cyclical feel. The message from price? Traders treated the geopolitical and oil risk as something to manage selectively, not a reason to step away from equities. Here's the context that tied it together. Two forces pulling in opposite directions. First, energy shock inflation fear, oil as the tripwire that can reprice rates fast. Second, optimism around AI and mega-cap earnings power, where traders were willing to pay up for liquid tech leadership anyway. Today didn't fix that macro tug-of-war. It just showed that for now, positioning still wants upside exposure, while keeping some respect for the tail risk. On the chatter front, there wasn't a big rumor list in play today. But days like this can still trade on fast-moving narratives, especially around geopolitics and oil, so keep a clean filter. If it isn't confirmed, it's just a volatility catalyst, not a fact. Today, the more reliable signal was the tape itself. Buyers leaned into growth while defensives lagged. Oracle was the headline stock inside the rally. ORCL jumped about 12.5%. The stated catalyst was enhanced AI capabilities and upgrades inside its utilities industry suite, along with related platform updates. Why it mattered today? A double-digit move in a heavyweight like this creates real sector gravity, supporting software sentiment and keeping the overall risk-on bid energized. Microsoft played the role of session general. MSFT rose a little over 3.5% as money rotated into mega-cap software and AI platform exposure. When a name this liquid and this heavy is up more than 3%, that's not background noise. It's a signal that both systematic and discretionary flows leaned back into growth leadership. Nvidia stayed in the green, NVDA up roughly 1/3%, but it wasn't the chase vehicle today. And that's actually constructive. Leadership held, while the market broadened into software instead of just piling into the same winner. The watch item is still the same macro linkage. If oil and rates flare, high-duration AI can get derated fast. Broadcom was another important confirmation point. AVGO gained a little over 2%, fitting that AI plumbing part of the stack, more infrastructure than app layer. Paired with software leadership, it suggested sponsorship wasn't locked into just one pocket. But here's the nuance: if semis start lagging software, that breadth can narrow again. Exxon was basically flat, but still telling XOM up just a hair. Oil and geopolitics stayed in the narrative, yet the move in the stock stayed muted. The role is what matters here. Energy is still the macro tripwire in this story, because it's the transmission channel into inflation and rates expectations. Today's market managed to rally anyway, but traders kept that oil sensitivity on the dashboard. Lockheed Martin added the other side of the barbell. LMT rose just under 1%, consistent with a defense bid under a geopolitical overhang, even while the broader tape stayed risk-on and growth-led. It's a clean read. Traders didn't run from equities, but they didn't ignore headline risk either. Looking ahead, the near-term catalyst risk stays the same: ongoing geopolitics and oil headlines, because that's the pathway into inflation and rates. On the calendar for the week of April 20th, watch Tuesday, April 21st for retail sales, core retail sales, and pending home sales. Thursday, April 23rd brings unemployment claims and flash PMIs. And Friday, April 24th is revised University of Michigan consumer sentiment. None of that guarantees direction. It just sets up the next batch of potential volatility triggers. So the wrap. This was a software-led risk-on session, even with oil and geopolitics trying to steal the mic. Breadth looked healthy, and the market showed confidence by selling defensives instead of hiding in them. Now the question into the next session is simple. Does that growth leadership follow through? Or does the oil to inflation to rates tripwire finally start to bite? That's the handoff. Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.